Picture this. You get paid every 2 weeks. You pay your bills on time. You avoid unnecessary debt. You skip expensive vacations you cannot afford. Maybe you even bring lunch to work instead of buying it every day. By almost every definition, you're doing the responsible thing. So naturally, you expect your financial life to slowly improve. Not overnight, just little by little. But then, another year passes. Your salary is higher than it used to be. Your savings account has grown. And yet, somehow, financial freedom still feels strangely far away. You start wondering why people with similar jobs seem to move ahead faster. Did they earn more? Did they get lucky? Or are they simply doing something you're not? That's when an uncomfortable question appears. Am I working hard, but building wealth the wrong way? Because what separates many millionaires from everyone else usually isn't a secret investment. It isn't a six-figure salary. And it isn't waking up at 5 in the morning. It's something so ordinary that most people overlook it completely. It's also one of the most boring financial habits imaginable. In this video, we'll break down why this simple habit quietly creates enormous wealth over decades, why it feels almost invisible while it's working, and how you can build it without turning your life into a full-time finance project. If you enjoy calm, practical explanations about money and building long-term wealth, consider subscribing, because the biggest financial advantages are usually the least exciting ones. Saving protects your money. Investing multiplies your money. And those are two very different jobs. Most people believe they're the same thing. They're not. Imagine two people. Both save consistently. Both earn similar salaries. Both live below their means. The only difference is where their monthly surplus goes. One keeps it entirely in cash. The other automatically invests it into a diversified, low-cost index fund. Same discipline, very different destination. Let's make it simple. Suppose both people set aside $500 every month. The first person places every dollar into a savings account, earning around 2% annually. After 30 years, they have contributed $180,000. Thanks to interest, their balance grows to roughly $245,000. Not bad. Now look at the second person. The same $500 every month for the same 30 years, but invested with an average annual return of around 8%. Their account grows to nearly $750,000. Same income. Same monthly contribution. No lottery ticket. No perfect stock picking. Just a different destination for the exact same habit. The surprising part isn't the math, it's the psychology, because almost nobody feels rich while this process is happening. In fact, it often feels like nothing is happening at all. The first few years, the numbers barely move. The progress looks painfully ordinary, which is exactly why so many people quit before compounding finally begins doing the heavy lifting. Our brains are designed to notice immediate rewards. Compounding offers delayed rewards, and delayed rewards rarely feel exciting. That's why boring habits outperform exciting decisions, not because they're more entertaining, because they're easier to repeat. Now you might be thinking, but what if I lose my money? That's a fair question, and it's exactly why understanding the difference between investing and gambling matters. Many people picture investing as constantly buying and selling stocks, watching financial news every morning, trying to predict recessions, guessing which company will become the next giant. That's speculation. Long-term investing looks much less dramatic. It means buying small pieces of hundreds or even thousands of businesses through diversified index funds, then continuing to buy, regardless of headlines. Some years will be positive, some years won't. Markets rise, markets fall. But over long periods, productive businesses have historically continued creating value. No one knows what next month will bring. That's why successful investors focus on the next 30 years instead. So how do you actually build this habit? Let's break it into simple stages. Step 1. Pay yourself first. Most people save whatever remains after spending. The problem is that something always seems to come up. A birthday, a sale, a repair, an unexpected subscription. Eventually, there's nothing left. Instead, flip the order. The moment income arrives, move a fixed amount toward your future before your current lifestyle expands to consume it. Even if it's only $100, consistency matters more than size. Step 2. Automate everything. Willpower is unreliable. Life gets busy. People forget. Motivation disappears. Automation removes the daily decision. Instead of asking yourself every month whether you should invest, the decision has already been made. One transfer, every paycheck. Without emotion, without negotiation. Step 3. Increase contributions slowly. Whenever your income grows, avoid letting every raise become a lifestyle upgrade. If you receive a salary increase, consider directing part of it toward investing before you become accustomed to spending it. You won't miss money you never learned to depend on. Over time, these small increases become surprisingly powerful. Step 4. Ignore the noise. Financial news exists because uncertainty attracts attention. Markets move every day. Predictions change every day. Experts disagree every day. But your investment plan shouldn't change every day. The wealthiest long-term investors often look inactive from the outside. They're not winning because they're making more decisions. They're winning because they're making fewer unnecessary ones. This is where the boring part becomes your advantage. Think about brushing your teeth. You probably don't wake up excited to do it. You don't expect dramatic results tomorrow morning. You simply repeat the habit because tiny actions prevent much larger problems later. Investing works in much the same way. No single brushing transforms your teeth. No single investment transforms your finances. But skipping the habit repeatedly has consequences. The results come from accumulation, not intensity. Here's another way to picture it. Imagine placing one seed into a jar every single day. The jar doesn't look very different after a week, or even a month. You might even wonder whether the habit matters. But keep going long enough. Eventually, the jar becomes impossible to ignore. Compounding works exactly like that. Each contribution seems insignificant by itself. Together, they become something remarkably difficult to recreate later. Many people search for extraordinary financial breakthroughs, a perfect investment, a hidden opportunity, a once-in-a-lifetime trade. But wealth is usually built through ordinary actions, repeated for extraordinary lengths of time. That's why the habit feels boring, because if it felt exciting every day, it probably wouldn't be sustainable. The goal isn't constant stimulation. The goal is consistency. There's another lesson hidden here. Millionaires aren't necessarily people who earned extraordinary incomes. Many certainly did, but countless others simply allowed ordinary habits to continue uninterrupted for decades. Time quietly amplified what discipline started. That's why beginning earlier matters so much. Not because you're smarter, but because time becomes another contributor alongside your monthly deposits. If you're starting later, that doesn't mean you failed. It simply means consistency becomes even more valuable from today forward. The best time to begin may have been years ago. The second best time is before another year quietly passes. Let's quickly recap. First, pay yourself before you spend. Second, automate every contribution. Third, increase your investing as your income grows. Fourth, ignore short-term noise and keep repeating the habit. None of these steps are complicated. None require predicting markets. None require working 80-hour weeks. They're simply designed to remove friction, so consistency becomes almost automatic. Because real financial security rarely comes from hundreds of ordinary ones that nobody notices while they're happening. Freedom isn't built by chasing excitement. It's built by reducing the number of financial decisions that depend on motivation. And perhaps that's the biggest irony of all. The habit that creates millionaires is often the one that feels too boring to matter, until one day it matters more than anything else. Before you go, I'd love to know where you are in your own journey. Are you still building the habit of saving consistently? Or have you already started investing automatically every month? Let me know in the comments.